The first tax most self-employed people try to beat is usually not the tax that is beating them. That is the brutal part. They spend years hunting deductions, forming entities, chasing write-offs, buying things they did not need, and telling themselves they are getting smarter. While the real money drain keeps standing right in the road like a toll booth they never bothered to study. I have watched this for a long time in different forms. Human beings will work very hard to avoid the pain they can see. They are much lazier about the pain that arrives in plain language, but through a mechanism they do not emotionally understand. And if you are self-employed, that mechanism can quietly gut you. You think you have a deduction problem. You usually have a toll booth problem. Every dollar you earn from active work has to drive through a gate. If you are a W-2 employee, you feel only half of that gate. The other half is paid by your employer in a way that is so quiet most people never build the right emotional picture. They complain about withholding, but they never really feel the second lane because it never lands in their hands first. Then they become self-employed. Now they are not just the driver, they are the company. They are both vehicles showing up at the same booth. Both halves of the charge belong to them. And for the first time, the gate is visible. That is why so many freelancers, consultants, solo operators, and early business owners feel like they got hit by a truck the first time they see a tax return after a good year. They say they only made $50,000. They say they are not rich. They say the tax bill feels insane. They say they must be in some crazy tax bracket. Usually they are not seeing one tax. They are seeing two systems stacked on the same body. They are seeing income tax, then state tax. If they live in the wrong place for denial, then sitting there like a second blade, self-employment tax. That is the moment people discover the gate, and because they discover it late, they start doing what frightened people always do. They grab the nearest story that sounds like strategy. That is where the damage begins. I want to tell you something very clearly, because the average person has been trained to love labels more than mechanics. An LLC is not a miracle. Real estate is not a magic eraser. A second business with losses is not an automatic shield. A stack of deductions is not the same thing as a lower self-employment tax bill. Those stories can make you feel active. They do not automatically move the needle you think they move. That is why I call it the toll booth, because most people are decorating the car when they should be redesigning the route. The first thing you need to understand is what the gate actually charges. Self-employment tax is not a special punishment for ambition. It is not the government inventing a new insult because you decided to work for yourself. It is the same Social Security and Medicare tax structure that already existed when you were a W-2 worker. The difference is not the existence of the tax. The difference is visibility and burden as an employee. You were paying part of it and your employer was paying the other part. As a self-employed operator, you are both. That is where the famous 15.3% comes from. Half of that pain was always real. You just were not forced to look at it. Now you are. This matters because until you see the toll booth correctly, everything else becomes superstition. People start talking about tax tricks the way gamblers talk about lucky rituals. They change business cards. They file paperwork. They move pieces around on the board. But the gate is not charging you based on your excitement. It is charging you based on the nature of the income moving through it. That is the hidden mechanism. Active income gets measured, not vibes, not branding, not online mythology. Active income, if you work in the business, if the income is tied to your labor, if the money is coming through your own hands and services, the gate cares. Wages have payroll tax. Schedule C profit has self-employment tax. Active partnership income can have it. The labels differ. The underlying logic is the same. The gate is charging labor. That sentence should change the way you think. The gate is charging labor. The reason that matters is simple. If the tax is attached to active labor, then half the nonsense people try has almost no power over the real problem. They are moving furniture in the waiting room while the toll collector keeps doing his job outside. This is where I want to get harder, because softness confuses people. A lot of self-employed people are not actually planning. They are bargaining with reality. They want the life of an owner while still thinking like an employee. They want higher gross income without accepting that the structure of the income matters. They want to hear that one legal wrapper, one side business, one real estate purchase, or one random write off will cause the booth operator to salute and wave them through. That is not how the world works. You do not lower a tax by wishing the tax were attached to something else. You lower it by understanding the base it is attached to. That is the difference between a grown operator and a busy amateur. The amateur asks, "What can I buy?" The operator asks, "What is the tax actually measuring?" The amateur asks, what entity can I form? The operator asks, what income is actually flowing through the gate, and on what legal basis? The amateur asks, how do I look sophisticated? The operator asks, what part of my income is compensation for labor? What part is return on capital? And what part is simply fantasy in a cleaner jacket? That is why the next part matters so much. I want to show you the decoys, the beautiful exits that usually do not take you where you think they do. The first decoy is real estate. People hear that real estate is tax efficient and they start using it like a religious answer to every problem they have not understood. There is a reason real estate gets sold this way. It has genuine strengths in income tax planning. Depreciation can matter, long-term appreciation can matter, timing can matter, but that does not mean a rental property reaches backward in time, grabs your active business income by the throat, and makes your self-employment tax disappear. It usually does not. That is because the toll booth is charging active labor income. A rental property, when it is actually functioning as rental property and not as disguised labor or dealer activity, is not retroactively changing the active income that already went through your business gate. It may help in other dimensions. It is not the universal answer people sell from a stage. I call this the side road illusion. A side road is not an exit if it does not connect to the gate you are trying to avoid. A lot of people buy the side road. Then they are shocked to discover the toll booth is still right there on the highway. They are actually driving every day. The second decoy is the LLC. This one is almost comical because it survives mostly on the power of appearance. Put 3 letters after the business name, get a stamped filing, open a new bank account, and suddenly people feel they have crossed into sophisticated territory. Legally, maybe they changed something useful. Tax-wise, often they changed almost nothing. An LLC is a legal shell. It is not a magic tax event. A single-member LLC is often disregarded for federal income tax purposes. That means the tax system often looks straight through it. The shell exists, the toll booth does not care. The income is still your active business income. The car changed paint, the route did not change, even with a multi-member LLC. The mere existence of the entity does not automatically destroy self-employment tax exposure on active income. People confuse legal form with tax outcome because legal form is easier to buy. Tax outcome demands actual structural understanding. That confusion is expensive. I call it the shell illusion. The shell illusion is what happens when a business owner pays for a cleaner wrapper and mistakes it for a different engine. That is a dangerous habit in finance. Beautiful wrappers seduce people into ignoring the actual source of returns, risks, or taxes. A wrapper can matter, but when people treat it like sorcery, it becomes a liability because it replaces thought. The third decoy is one of my favorites because it reveals how badly most people understand tax bases. This is the wrong base fantasy. A household will have one spouse earning active business income and another spouse starting something else with losses. Or a person will stack deductions and losses from one place and emotionally assume everything should wash together the way water does in a sink. They imagine the total pain should vanish because on paper one side looks big and negative enough to cancel the other side. But self-employment tax is not computed on household emotion. It follows who earned the active income. That is the knife most people miss. The wrong base fantasy is just the belief that because one number on the return got smaller, every tax attached to a different base should also get smaller. That is not planning. That is category confusion. And category confusion is where small businesses lose a lot of money. This is one of the reasons I am always talking about incentives and definitions. You cannot allocate capital. Well, if you do not know what game each dollar is playing. Some dollars are playing the income tax game, some are playing the payroll tax game, some are playing the capital return game, some are playing the legal substance game. If you treat them all like one big emotional pile called taxes, you will spend 5 years rearranging your life for cosmetic victories. That is what a lot of self-employed people do. They build tax theater. Tax theater is the performance of sophistication without the transfer of real advantage. It feels active. It produces conversations. It gives you folders, entities, apps, subscriptions, and opinions. But when you ask the only question that matters, what legitimately reduces the amount of active income exposed at the gate, the whole stage set starts wobbling. Now we get to the part that actually matters, what really changes the outcome. There are not many levers. That is the good news and the bad news. The bad news is that the internet has sold you a warehouse full of glittering nonsense. The good news is that reality is usually simpler than bad marketing. Once you understand the few levers that actually matter, you can stop wasting motion. The first true lever is the capital return lane. This is where genuine limited partner treatment can matter. If income is properly characterized as return on invested capital rather than payment for active services, you are no longer talking about the same toll lane in the same way. That distinction matters enormously. The law has long cared about whether income represents labor or capital, and a bona fide limited partner under the right facts and real legal substance can stand in a different relationship to the income than the person actively operating the business every day. Notice what I did not say. I did not say this is a costume. I did not say this is a free pass. I did not say you can wave a title around and the toll booth goes blind. The analysis lives in status and substance. Are you truly a limited partner under state law? Are you functionally limited in management and participation? Is the income really behaving like a return on invested capital rather than compensation for services dressed up in polite language? If not, you are not in the capital return lane. You are just lying to yourself at the gate. That is why serious planning always sounds less fun than social media planning. Serious planning requires the structure to be true. Fantasy planning only requires the story to sound plausible. The second real lever is the split lane structure that people talk about online more than they understand. That is the S corporation. Now listen carefully, because this is where the internet does its best damage. People hear one phrase, pay yourself a salary and take the rest as distributions, and they think they have discovered a lever that works at any size, at any stage, under any facts. That is how amateurs get trapped. They hear a sentence, they never learn the conditions. An S corporation can reduce exposure because it separates two economic roles that are blended together in a sole proprietorship. In one role, you are a worker performing services. In the other, you are an owner receiving profits. The salary you pay yourself for real services is still subject to payroll taxes economically. That is the same kind of pain you are trying to understand. The potential advantage comes only if there is profit left over after a reasonable salary for the labor you actually perform. That phrase matters more than almost anything else. Reasonable salary, not convenient salary, not internet salary, not 30% because someone made a video. Reasonable salary is driven by what similar services would ordinarily be paid under similar circumstances. That is the real line. The law is looking at the value of the work, not your desire for a lower tax bill. If your business is too early, too thin, or too dependent on your labor, then most or all of the income may still need to come out as wages. In that case, electing too early can simply add compliance cost, administration, payroll complexity, and new headaches without much real savings. That is a classic small business mistake. People elect structure before they have economic room for the structure to matter. I call this premature sophistication. Premature sophistication is what happens when a person adopts a more advanced tool before the business has produced enough surplus to justify it. The tool becomes overhead, not leverage. That is true in taxes, it is true in finance, it is true in investing, it is true in business. A lever only helps when there is something meaningful to lever. The reason the S corporation story becomes so distorted is that people want formulas. They want clean percentages, they want a shortcut because shortcuts feel efficient. But finance punishes people who confuse convenience with accuracy. The reasonable compensation line is not a magic fraction of profit. It is a fact-based question about the value of the labor. As profit grows, distributions can grow. But wages do not automatically become a percentage game just because people online enjoy repeating one. This is why I always tell people the same thing. Do not use a structure because it sounds advanced. Use it because the economics now support it. There is a world of difference between those two decisions. The third real lever is deduction planning inside the actual business that is generating the active income, and for the taxpayer whose active income is being taxed. This is where people think they are planning when they often are not. Most business owners love the word deductions because it feels like winning. But deductions do not all hit every tax base the same way. A deduction can matter for income tax and still fail to move self-employment tax the way the owner emotionally expected. That is why loose talk here becomes costly. You need to know whether the deduction is properly attributable to the active trade or business and whether it truly reduces the net earnings from self-employment in the manner that matters. That means the real game is not collecting deductions like baseball cards. The real game is attribution. I call this the same taxpayer rule, the same. Taxpayer rule is simple enough for a child to understand and subtle enough for adults to ignore. The deduction has to live where the taxed earnings live. The planning has to belong to the business, and taxpayer actually exposed at the gate. If you do not understand that, you will keep celebrating deductions that lower one number while the more painful number stays largely alive. Retirement plan design can matter. Health insurance can matter in the right structure. Accountable plans can matter. Depreciation can matter. Benefit structures can matter, but the question is never, does this sound tax efficient in the abstract? The question is, does it reduce the earnings from active self-employment for the person and business actually paying the toll? That is a much stricter standard, and strict standards save money. This is also where stage matters. Early operators want maximum cleverness too soon. They want the full menu of strategies while the business is still a thin stream held together by labor. But the stage of business affects what is worth doing. In the earliest stage, the smartest thing may not be complexity. It may be simply budgeting for the booth, building enough margin into pricing, and not lying to yourself about what your take-home actually is. At the next stage, certain deductions properly implemented can matter a lot. At a later stage, the split lane structure may become worthwhile in a different setting. A true capital return lane may exist, but these levers are not interchangeable and they are not all ripe on day one. That is where judgment comes in. And judgment is what the average owner is avoiding when he asks for hacks. He does not want judgment. He wants a button. There is no button. There is only structure. This is why I want to drag the conversation away from tactics and back into identity. Because if you are self-employed, the deepest error is not technical. It is psychological. Most self-employed people still think like gross earners. They celebrate revenue. They celebrate invoicing. They celebrate the fact that the client paid. They celebrate the top line. They do not build an internal map of what belongs to the business, what belongs to the tax authorities, what belongs to future obligations, what belongs to them as actual owners, and what belongs to the gate. That makes them fragile. A fragile operator is not the person with low intelligence. It is the person with a blurry map. He sees money arrive and emotionally spends from the gross number. He does not carve out the hidden costs fast enough. He treats tax like a surprise instead of a design constraint. Then, when the return lands, he feels betrayed by a system he never bothered to understand. I am not sympathetic to that kind of betrayal. Confusion is not oppression. Sometimes confusion is just tuition. If you want to become wealthier as a self-employed person, one of the first adult moves is to stop romanticizing self-employment as freedom without structure. Freedom without structure is just exposure. You escaped a boss, fine. But now you are the one responsible for the compensation design, the entity design, the deduction design, the pricing model, the margin, the reserve policy, and the tax routing. If you do not handle those things, you did not become an owner. You just became a disorganized employee of yourself. That is one of the most common tragedies in small business. People increase autonomy and decrease architecture at the same time. That is backwards. Ownership should increase architecture, not decrease it. And the toll booth is where that truth becomes very expensive. Let me make the deeper point. The self-employed person who wins is not the one who hates taxes the hardest. It is the one who understands the economics of the taxes well enough to change behavior before the bill arrives. That can mean setting better prices because labor-heavy work has a tax burden that has to be carried honestly. That can mean deciding when the business has enough profit to justify an S-corporation structure. That can mean resisting the shell illusion and side road illusion. That can mean using real deduction planning instead of collecting random expenses. That can mean separating personal spending from business design. That can mean accepting that some years your biggest victory is not lowering the rate but increasing discipline around the route. The emotional trap is that this feels less glamorous than the tax trick stories. Of course it does. Reality is less glamorous than fantasy. But reality compounds. Fantasy bills by the hour. I want you to notice how many people are trying to win the wrong argument. They argue over whether taxes are fair. They argue over whether the system should work differently. They argue over whether self-employment is worth it. Those are mostly sterile conversations if your real goal is to keep more of what you earn. The productive conversation is much sharper. What income is being measured? Why is it being measured that way? Which parts of my structure are cosmetic? Which parts are substantive? Which levers actually change exposure at what stage, under what facts, with what trade-offs? That is a capital allocator S mindset, and make no mistake. If you are self-employed, you are now a capital allocator, whether you deserve the title or not. Your labor is capital, your entity choice is capital allocation, your compensation design is capital allocation, your reserves are capital allocation, your deduction structures are capital allocation, your refusal to understand any of that is also capital allocation. It is just bad capital allocation. The average person wants tax planning to feel like revenge. The smart person treats it like engineering. Engineering is better. Revenge burns hot and dumb. Engineering changes the root. There is another reason I like the toll booth metaphor. A toll booth does not care how offended you are. It does not care that you worked hard. It does not care that you are new. It does not care that the month was stressful. It charges what the road design tells it to charge. Once you understand that, you stop wasting emotional energy on theatrical outrage and start focusing on road design. Road design is everything. Is this income active labor income? Is this entity actually altering the tax character or merely the legal shell? Is this loss offset touching the right base? Is this deduction attributable to the right taxpayer and business? Is this S corporation election premature or timely? Is this compensation actually reasonable? Is this partner truly limited in substance and law? These are not sexy questions. They are expensive questions. That makes them worth asking. You should also understand the hidden business lesson buried inside all of this. The self-employment tax sting is often the first moment a small business owner is forced to confront the difference between being busy and being well-designed. Plenty of people can generate revenue. Far fewer can generate revenue in a structure that preserves enough after tax. After friction, after compliance, and after reality to become wealth. That is why two people can earn the same top line and build completely different lives. One builds with gross fantasy. The other builds with net clarity. One sees the tax bill as a surprise attack. The other saw it coming and designed around it months earlier. One forms entities to feel important. The other changes structure only when facts justify it. One buys side roads. The other studies the gate, and over 10 years that difference gets very large, because tax pain is not only about the money sent out, it is also about the behavioral damage caused by misunderstanding. A person who repeatedly gets ambushed by tax outcomes becomes more emotional. He underprices. He overreacts. He buys the wrong strategies. He adds sloppy complexity. He resents his own business. He mistakes motion for progress. Confusion bleeds into every other financial decision. A person who understands the gate behaves differently. He reserves better. He prices differently. He plans entity decisions with patience. He knows when a deduction actually helps and when it is a distraction. He does not confuse income tax planning with self-employment tax planning. He stops acting shocked by the same mechanism every April. That alone can be worth a fortune, because emotional stability is an underappreciated asset in business. You cannot allocate capital rationally if the basic mechanics keep humiliating you. So let me boil the whole thing down to one harsh truth. If you are self-employed and obsessed with lowering taxes, but you do not deeply understand self-employment tax, there is a very good chance you are fighting with the wrong weapon on the wrong battlefield. You are swinging at smoke while the toll booth keeps charging the part of your income that actually matters. That is why so many people spend years tax planning and barely move the needle. They are not stupid, they are misaimed. They are trying to erase a labor tax with stories that do not alter labor income. They are trying to use shells to solve substance. They are trying to use household emotion to solve taxpayer-specific exposure. They are trying to use formulas where facts control. They are trying to look advanced before the business has enough excess profit to make advanced structure worthwhile. That combination creates the most dangerous feeling in personal finance. The feeling of activity without progress. I despise that feeling. It is one of the main ways intelligent people stay stuck. They keep moving, so they assume they must be improving. Meanwhile, the economics underneath them remain almost exactly the same. The toll booth is still there. The collector still recognizes the same car. The charges still land. You do not need more motion. You need more truth. The truth is that there are only a few real levers. A true capital return lane under genuine limited partner facts can matter. A properly timed S corporation with defensible reasonable compensation and real excess earnings can matter. Business-specific, properly attributable deduction planning that truly reduces the right earnings base can matter. Everything else may or may not help elsewhere, but it is not automatically moving the part of the machine you are angry about. Once you understand that, something wonderful happens. Your frustration starts becoming precision. Precision is powerful. Precision lets you stop buying stories. Precision lets you stop performing sophistication. Precision lets you stop expecting the wrong strategies to solve the wrong tax. Precision lets you start building a business that can actually carry its own structure. And that is the real change. Not paying zero. Not beating the government in some childish fantasy. Not turning taxes into a magic trick. The real change is that you stop treating your business like a lucky paycheck and start treating it like an engineered system. The system earns, the system routes, the system reserves, the system compensates, the system documents, the system chooses structure only when reality justifies it. The system knows which lane each dollar is in before the year is over. That is how grown operators think, and that is the test in front of you. You can keep playing tax theater, you can keep forming shells, buying side roads, cheering random deductions, and hoping one of them somehow melts a labor tax that is still staring directly at your active income. Or you can do the harder thing. You can study the toll booth. You can accept that self-employment means you now own both halves of the problem. You can stop chasing symbolic sophistication and start building economic sophistication. You can price with the gate in mind. You can reserve with the gate in mind. You can structure with the gate in mind. You can choose the right lever at the right stage instead of grabbing every lever at once. You can stop asking how to sound smarter and start asking what actually changes exposure. That is the fork in the road. Not deduction versus no deduction, not LLC versus no LLC, not real estate versus no real estate, clarity versus theater engineering versus superstition. Route design versus dashboard decoration. And once you see that, your next move is obvious. Either keep driving your labor dollars through a booth you never bothered to understand and call the bill unfair every time it arrives, or become the kind of owner who knows exactly why the gate charges what it charges, which lane you are in. And when you have finally built a road, the booth cannot charge the same way anymore.